Welcome back to the deep dive. This is where we take that absolute fire hose of information on finance, on tech, on global risk, and we try to distill it down.
Right, down to the essential insights, the things you really need to know.
And today we are peering deep into the architecture of modern finance.
We are. Specifically at that intersection of these, well, these powerful and sometimes notorious financial instruments and the colossal piles of debt that are funding the world's biggest technological bet,
Artificial intelligence.
artificial intelligence. And our jumping off point for all of this is the credit default swap, the CDS.
And we're not just looking at CDS as, a history lesson from 2008. We're looking at it as a living, breathing mechanism. A financial sentinel, really.
That's the perfect way to put it. We're going to apply the lessons, of very hard lessons, learned from the chaos of the GFC, directly to two massive interconnected risks that are dominating today's headlines.
So first up is the enormous debt-fueled infrastructure push. We're talking about companies like Oracle.
And second, we're looking at the exponentially increasing hidden systemic risk that's just lurking in the shadows of the private debt market.
A market that's now, what is it, $1.7 trillion.
$1.7 trillion and growing fast. So that's the mission today. Our deep dive is going to use the latest financial engineering concepts, the latest quantitative models to really illuminate where the true fault lines are forming right now.
So if you want to understand the systemic fragility of modern leverage, and I think we all need to, we have to start at the foundation.
We have to start with the technical foundation.
Yeah.
We have to start with the CDS itself.
Okay, let's do it. Let's unpack that foundation.
Okay.
For anyone who maybe hasn't spent their days modeling derivatives, give us the crisp definition. What exactly is a credit default swap?
Right. So fundamentally, a CDS is, well, it's a derivative contract.
A bilateral agreement, right, between two parties.
Exactly, a bilateral agreement. And the key mechanism is, it's actually pretty simple at its core. You have a protection buyer,
Okay.
and they pay a periodic fee. We call that the spread.
Like an insurance premium.
Precisely. It's like an insurance premium, and they pay that to a protection seller. In return for that fee, the seller agrees to pay the buyer this massive lump sum, but only if a specific credit event occurs.
So something like a bankruptcy?
Bankruptcy, a failure to pay on their debt. Something that signaled the company is in real trouble. So you can think of it as insurance on a bond, where the buyer pays a premium and the seller takes on the risk.
And you cannot talk about this structure without bringing up the massive shadow of the global financial crisis.
You can't. It's impossible. The GFC provides the essential context for understanding why these mechanics matter so much.
It's the why?
It's the why. Before 2008, the CDS market had, well, it had ballooned into this colossal, opaque, just a $60 trillion behemoth.
60 trillion. It's a number that's hard to even comprehend.
It is. And because these trades were overwhelmingly conducted over the counter,
Meaning they were private.
private bilateral contracts with no central oversight, no clearinghouse, nothing. That opacity just amplified systemic risk across the entire globe.
And AIG became the poster child for that systemic failure, didn't it?
It absolutely did. AIG, or more specifically its financial products division in London, they wrote protection on approximately $440 billion worth of debt.
An unbelievable number.
It's staggering, right? And when the underlying credit, which was largely linked to those structured mortgage products, when that began to collapse,
A cards comes down.
it came down fast. AIG didn't have the collateral. They didn't have the reserves to cover those potential payouts. Its near collapse required a massive taxpayer bailout
Yeah.
because the entire system was just too interconnected to let it fail.
And that is the danger. That's the systemic risk we're trying to understand today to see if it could happen again.
That's it, to prevent it from recurring.
So if we accept the stakes are this high, we have to get into the science behind the pricing. How is this insurance premium, this CDS spread, how is it mathematically determined? It sounds incredibly complex.
It does. And it involves core financial engineering, but we can really distill it down to the essential concepts.
Okay.
When market participants, the banks, the hedge funds, the insurers, when they value a CDS, they're calculating something called the par spread.
The par spread.
The par spread. And that's just the annual premium. It's quoted in basis points. That makes the contract fair from the get-go. It ensures a no arbitrage condition.
And what are they balancing to achieve that fairness? What are the two sides of the scale?
They're balancing the present value of two distinct cash flows. We call them the legs of the swap.
The legs. Okay.
So first you have the fee leg or the premium leg. That's the stream of expected payments that the buyer makes. That premium they pay every quarter or so until the contract matures or the company defaults.
Right. The known payments.
The known payments. And on the other side, you have the contingent leg, or the protection leg. And this is the expected payout the seller might have to make if that credit event happens.
So it's a probability-weighted payout.
Exactly. And the whole calculation just ensures that the present value of that premium leg equals the present value of the protection leg. That's the no arbitrage point.
So you're essentially quantifying the chance of an accident and the size of the expected damage. What are the key variables? What do you need to plug into the model to get these present values?
There are 3 critical inputs, and these are pretty standard based on the models that came out of places like JP Morgan.
Okay, what's number 1?
First, you need a riskless discount factor, or DF. This is standard finance stuff. We have to bring all future cash flows back to today's value using a risk-free rate, usually from swap rates or treasuries.
Simple enough.
Second, and this is the most critical part, is the no default probability, the PNBI.
The probability of survival.
Yes, exactly. The probability that the company survives without defaulting up to a specific point in time. Because if the entity defaults, well, the premium payments stop.
Right. And what determines the size of the payout if they do default?
And that brings us to the third variable, the recovery rate, which we call LST. This is the estimated percentage of the principal that investors think they'll get back after a default.
Through bankruptcy court or whatever follows.
Right. It's also standardized, maybe 40% for senior unsecured debt, for instance. But the actual loss, the thing the CDS covers, is called the loss given default. And that's just 1R times the notional amount of the swap.
That seems like a lot of variables. I mean, when you look at the actual technical notes, it's full of complex summation formulas. For the listener who just wants to get a feel for the market's mood, is there an intuitive shortcut? A rule of thumb?
Absolutely. And this is probably the single most powerful insight you can take away from CDS pricing. It's called the credit triangle rule of thumb.
Okay, I like it. The credit triangle.
It captures the core relationship perfectly. It's this. The spread, S, is approximately equal to the default probability, P, multiplied by the loss given default, which is 1R.
Wait, okay, let me repeat that back because that is the key. The price of the insurance, the spread, is essentially just the probability of the company failing times how bad the loss is expected to be.
That is the entire story in a nutshell. The spread is the market's instantaneous, real-time reflection of perceived credit risk.
Give us an example.
Sure. So if you see a company's 5-year CDS trading at a spread of 50 basis points,
0.5%.
0.5% per year, and the market generally assumes a 50% recovery rate for that kind of debt, you can immediately infer that the market is pricing in an implied annual default probability of 1%.
Because 50 basis points divided by the 50% loss equals 100 basis points or 1%?
You've got it. That simple insight is why CDS is such a powerful clean market indicator. It cuts through all the noise.
So why did this market get so huge? I mean, if you want to bet against a company's ability to pay its debts, why not just short their bonds?
And that's where the revolutionary aspect of CDS as a trading tool really comes in. Before CDS, shorting corporate bonds was extremely challenging. Well, you had to physically borrow the bond you wanted to short. That depended on the corporate repo market, which is very opaque. And the inventory of bonds could be sticky or just flat out unavailable.
So you might not even be able to put the trade on.
Right. But CDS enabled investors to easily and cleanly short credit just by buying protection. Or, conversely, to get long credit exposure by selling protection without ever having to buy the actual underlying bond.
So it unbundled the risk. It gave investors pure credit exposure separate from everything else.
Precisely. CDS separated that pure credit risk, the risk of failure, from all the other messy technical risks that come with a physical bond.
Like what? Interest rate risk.
Interest rate risk, illiquidity, specific technical flows related to that one security. All of that gets stripped away. The CDS market provided this highly liquid, standardized way to trade the credit risk itself.
And that must have unlocked all sorts of new strategies.
It turbocharged them. Sophisticated strategies like capital structure arbitrage became possible, allowing traders to exploit these subtle differences in pricing between a firm's bonds, its loans, and its CDS contracts.
Now, if you're a protection buyer, your risk isn't just waiting for default. Your hedge is changing value every single day, right? Even if the company is doing fine.
Correct. That's the mark-to-market risk, or MTM. The value of your CDS contract fluctuates daily based on shifts in market perception. If the credit spread widens, meaning the market thinks the risk has increased, the protection you bought becomes more valuable.
And you can book a gain on that.
You could book a gain, and that concept is vital. Your hedge provides a kind of synthetic liquidity because you can liquidate your position or book gains and losses daily, even if the underlying bond itself is very hard to trade.
So let's talk about the trigger. What actually pulls the lever and causes the protection seller to have to write that massive check?
It has to be a formal credit event, and these are strictly defined by IOSDIA, the International Swaps and Derivatives Association.
The governing body for all this?
That's right. For corporate entities, there are 3 standard events. Bankruptcy, which is what it sounds like.
The company becomes insolvent.
Right. Then there's failure to pay, which is missing a scheduled debt payment after any grace period. And the third one, which was the most contentious, is restructuring.
Historically, those triggers have led to some huge headlines. Can you remind us of some of the defining examples?
Certainly. Bankruptcy is the cleanest one. Think of the big airline filings like Delta or Northwest, or the auto supplier Delphi back in the early 2000s.
Straightforward.
Very. Failure to pay is often associated with sovereign defaults. Countries like Argentina intentionally missing a bond payment. But the most challenging and systemically difficult event was always restructuring.
Why was that one so messy?
We saw with companies like Conseco where they materially altered their debt obligations to avoid an outright bankruptcy. It was messy because of a specific feature designed into the early CDS contracts.
You're talking about the infamous cheapest to deliver option.
That's the one.
What was that, and why did it create so much chaos in the market?
The cheapest to deliver option was a provision that really empowered the protection buyer to maximize their payout. If a credit event occurred, the buyer had the right to deliver any of the company's bonds or loans that qualified under the contract's terms.
And naturally, they would choose the one that's trading at the lowest price in the market.
Of course. So even if you were hedging a specific short-term bond that you owned, if a restructuring happened, you could go out and buy a completely different, lower-priced, long-term bond from the same company to deliver.
Which decouples the hedge from the actual risk you were trying to cover.
Completely. In that Conseco case, some of their long-dated bonds were trading down at, say, $66, while the bonds people were actually hedging were still trading closer to $80. The buyers delivered the $66 bonds, they maximized their profit, but this created these acute supply issues and market distortions.
A short squeeze, basically.
A short squeeze. Protection sellers were scrambling to acquire these specific bonds to meet their obligations, sometimes artificially driving up the price. It was a major source of basis risk and instability.
And how was this physical exchange handled back then?
Pre-GFC, the standard was physical delivery. The buyer would literally hand over the defaulted bonds to the seller and receive 100% of the notional value in cash. As we saw, that process could lead to all sorts of problems.
Right.
So the post-GFC reforms largely mandated a shift to a much more streamlined cash settlement via a transparent auction process. That's now the industry standard, and it effectively resolved most of that physical delivery chaos.
Okay, here's where it gets really interesting, and it has a direct impact on the stability, or lack thereof, that we see today. The system was almost brought down by the opacity of these swaps.
It was.
So the Big Bang reforms came in and fundamentally changed how all of this works to prevent that kind of collapse from happening again.
It was a recognition that a market based on non-standardized, bilateral, over-the-counter contracts was a systemic time bomb. So the ISDA Big Bang Protocol of 2009 was a fundamental overhaul. The goal was simple: standardization, transparency, and mitigating counterparty risk.
What were the 3 major surgical strikes they used to repair the market?
The first major fix was the settlement mechanism we just talked about. They hardwired cash settlement via auction into the standardized contracts.
Making it the default.
Making it the default. By eliminating physical delivery, they dramatically reduced that basis risk, and they provided a transparent, standardized way for the entire market to establish the true loss given default at the same time.
Okay, so that's one. The second fix tackled the consistency of the contracts themselves, right? To stop the, endless proliferation of these one-off bespoke contracts.
Yes, exactly. They introduced standardized contracts, or SNA, focusing first on North American corporate terms. This involved fixing the coupon payments to specific market standard rates, usually 100 or 500 basis points.
Which immediately makes them more fungible. You can trade one against another.
Instantly. And, crucially, they tackled that restructuring issue head-on. For new U.S. investment-grade CDS trades, they removed restructuring as a standard credit event. They created what are called no-R contracts.
And they did that specifically to eliminate the chaos from that cheapest to deliver option we just discussed.
That was the entire point. So the U.S. market basically traded the flexibility of getting protection in a mild restructuring event for a dramatic increase in contract standardization and liquidity.
It was a regulatory bargain. You increase certainty by removing an event that previously let buyers maximize these weird arbitrage profits at the expense of overall market stability.
That was the trade-off. Now, modified restructuring, or MMR terms, still remain the standard in Europe, but the U.S. shifted hard to NOR to ensure that contract clarity.
Okay, and the third major fix. This one goes directly to the AIG problem, counterparty risk.
That was the absolute linchpin of the reforms, the establishment of the Central Clearing Facility, or CCF, primarily IC Trust, which is now IC Clear Credit.
So explain how that works. How does that solve the AIG problem?
Well, before the CCF, if you bought protection from AIG, your risk was AIG. If AIG failed, your protection was suddenly worthless.
Right when you needed it most.
Exactly. With central clearing, all the dealer-to-dealer trades are novated.
Novated.
Meaning the CCF steps into the middle of the trade. So now both parties face the highly regulated and capitalized clearinghouse, not each other.
So you concentrate the risk onto one highly regulated entity, but in doing so, you slash that spaghetti-like web of bilateral connections.
You got it. ISDA estimates that this single change slashed the systemic counterparty exposure among major dealers by about 70%.
70%. That's huge.
It's the single biggest protection that was implemented after 2008. The shift from over-the-counter to centrally cleared, standardized derivatives is why the market today is structurally much, much safer than the pre-GFC world.
And that push for standardization didn't stop there either. Transparency is key for benchmarking, for just knowing what things are worth.
It is. And that transparency drive led to the 2011 co-branding of the major CDS indices, CDX for North America, and iTraxx for Europe and Asia with S&P.
Which makes them more official, more visible.
It allows any investor to easily benchmark their own perceived risk against a standardized, actively traded basket of credits. It further integrated the market and just increased clarity for everyone.
It seems like the financial infrastructure is in this constant state of playing whack-a-mole with operational risk. Are there still updates being developed even now, 15 years later?
Absolutely. The focus is shifting now from the big structural credit risks to operational resilience, ensuring the plumbing works seamlessly, even under geopolitical or technological stress.
So like what?
Look at the ISDA 2025 Notices Hub protocol, which just launched in July of 2025.
A notices hub. That sounds very administrative.
It is. But administrative failure can trigger billions of dollars in losses. Think about it. Formal notices, like a notification that a credit event has even happened, they have to be delivered accurately and on time.
And if they're not?
If global internet infrastructure is disrupted, or banking communications go down, or a dealer literally misses a fax, the resulting confusion can cause severe market dislocation. So the hub digitizes and standardizes this whole delivery process.
So it's a quiet but absolutely critical safeguard against chaos.
Yes. Simulations projected that implementing this hub protocol would reduce the risk of notice failure by over 90%. It's the constant, unglamorous work of refining the infrastructure that keeps the system stable.
So we have the foundation, we understand the fixes that came out of the GFC. Now let's apply this financial science to today's risk landscape and these massive bets being placed on AI infrastructure, particularly by tech giants, leveraging huge amounts of debt that they're raising a lot of eyebrows. Let's start with Oracle.
Oracle is the perfect modern case study. It's innovation meeting leverage head-on. Following their acquisition of Cerner and this major pivot into cloud and AI infrastructure, Oracle has gone on an extremely aggressive borrowing spree.
This isn't their old business model.
Not at all. They're funding a colossal capital expenditure plan, something like $80 billion annually, to build out the AI data centers they need to compete with giants like Amazon and Microsoft.
It's a full-blown arms race, and it's being funded by debt.
It is. Their existing debt load was already over $100 billion. This new expansion involves these multi-billion-dollar commitments, including a projected cloud deal with OpenAI that some analysts are putting at $300 billion over its lifetime.
And it's not just promises, it's actual loans tied to this.
Yes, more specifically, we're tracking $65 billion in developer loans that are tied directly to building these superclusters for their partnerships, like the big one they announced in Abu Dhabi.
And that level of ambition and debt translates directly into how the market perceives their risk.
It has to. Morgan Stanley put out a note projecting Oracle's net debt could swell to nearly $290 billion by fiscal year 2028.
Wow.
And that pushes their leverage ratio dangerously close to 4x net debt to EBITDA. In the financial world, For a company with a BBB rating, that's where the safety margin starts to look pretty thin.
And this is exactly where the credit default swap market acts as our highly sensitive sentinel. The CDS market doesn't wait for a quarterly report or an equity analyst to tell it what to think. It reacts instantly.
Instantly.
So what did the CDS spread tell us in late 2025? What was the signal?
The data was striking. I mean, it was alarming. Oracle's 5-year CDS spread surged to 110 basis points by late November 2025.
And just to put that in perspective for everyone.
That is the highest level of perceived credit risk we have seen for Oracle since the financial turmoil of 2009.
So that's a powerful psychological indicator. The market is pricing in a risk premium that reflects its memory of the last great crisis. Was the spike gradual or was it sudden?
Oh, very sudden, which confirms that it was market nerves. We saw a sharp single-day leap of 13.5 basis points. That pushed the spread right past that critical 100 BPs mark to 102 BPs on November 14th alone.
And that fear translates into real hedging.
Immediately, volumes in Oracle CDS just exploded. We saw $8 billion traded in a 9-week period, driven by banks and large institutional investors who are seeking protection against their exposure, especially to those $65 billion in developer loans for the new data centers.
Okay, let's apply that credit triangle rule of thumb we talked about earlier. The market is pricing risk, clearly. But is it pricing the risk of default? Or is it pricing something else?
And this is the critical juncture. This is the AI hedge analysis. You have to compare the market's pricing mechanisms. So if you look at Oracle's equity implied default probability, the EDF.
Which is derived from its stock volatility and balance sheet.
Right. It was actually quite low, maybe around a 0.5% annual probability, which suggests the stock market is still very bullish on the long-term AI growth story.
But what about the CDS market?
Well, when you use the CDS spread, let's call it 110 BPS, and you assume a standard 40% recovery rate, the CDS model implies a significantly higher annual default probability of 1.1%.
So there's a clear discrepancy, a risk wedge, you could call it. The CDS market sees the risk as being almost 1.8 times higher than the equity market does.
That 1.8x wedge is not just speculative noise. It is a clear liquidity and systemic risk premium being priced in.
Meaning what?
Meaning traders are buying this protection not necessarily because they believe Oracle is going to default tomorrow. They're buying it because the CDS is the most efficient instrument they have to hedge against a broader systemic AI credit stress event that could hit the entire debt-fueled tech sector.
So in other words, they're insuring against the possibility that the market just decides this whole massive AI debt structure is over-leveraged and unsustainable, a major loss of AI sentiment.
That's it exactly. If that sentiment wanes, spreads across the sector will widen, and the people who bought protection will profit.
And there have been specific warnings about this.
Morgan Stanley issued a stark one. They noted that spreads could easily breach 150 basis points in the short term and potentially hit 200 if that AI hype bubble truly deflates and the debt burden becomes onerous.
And the ultimate danger here is their BBB rating.
That's the trapdoor. A shift in market perception could lead to a downgrade cascade, which would force index funds and institutional mandates to sell their bonds, which would create a self-fulfilling crisis in Oracle's credit.
So the single-name CDS on a tech giant like Oracle is acting as a real-time, high-frequency sensor for potential systemic fault lines forming in the new economy.
That's what it's there for.
Okay, now let's zoom out. From that single corporate risk to a market that truly echoes the GFC's worst nightmares in terms of opacity and exponential growth. The private debt market.
The shadow banking system.
This is the shadow banking system, and it's ballooned to $1.7 trillion.
The growth rate here it's just unprecedented. And the anxiety among regulators is palpable. Private debt, so direct lending to middle market companies, non-investment grade firms, has exploded to $1.7 trillion in assets under management.
And the projections are even scarier.
Projections suggest it will hit $2.8 trillion by year end.
So why the explosion? Where did all this money suddenly come from?
It's a direct consequence of the 2008 reforms. Post-Basel III regulations forced the major commercial banks to dramatically retreat from leveraged lending because of higher capital requirements.
They couldn't take the risk anymore.
They couldn't. And this created a massive vacuum that private credit funds, these non-bank lenders, were more than happy to fill.
And the allure for investors is obvious.
Of course. You get high yields, 9–13%, and most of the loans are floating rate, which offers protection against rising interest rates. It looks like a perfect product.
But the very nature of private implies a lack of scrutiny, a lack of transparency. So where exactly are the hidden GFC analogies lurking in this $1.7 trillion pile?
I'd say there are three critical interconnected risks. And the first one is the biggest immediate concern, which valuation opacity. It's a black box. Unlike publicly traded bonds, or CDS, an estimated 70% of these private debt portfolios lack true, verifiable mark-to-market valuations.
The loans are just held privately.
Right. And the valuations are often done maybe quarterly, sometimes less frequently, and usually by the funds themselves, which can lead to, let's say, a smoothing over of losses.
And this is what Jamie Dimon called the cockroach risks, right? You don't know the extent of the damage until it's way too late.
That's it, exactly. Losses, if they exist, are embedded. They're hidden, or at least delayed in their reporting. Imagine a scenario where interest rates jump and borrowers start to struggle.
Okay.
In the public market, you'd see distressed trading prices immediately. But in private debt, the fund manager might hold that loan at par for months, masking the underlying distress and delaying the necessary recognition of loss.
Which just amplifies the panic when the light is finally turned on.
Massively. So what's the second risk, then, related to the lack of trading?
The liquidity.
Illiquidity amplification. While the spreads on these private loans are attractive, the secondary market for them is thin. It's almost non-existent in some cases.
So if you want to sell, it's hard.
It's hard. Private loans often trade at significant discounts, maybe 50 to 100 basis points below where a comparable public corporate loan would trade, just to attract a buyer at all. So if a systemic shock happens,
Say a cluster of defaults in one sector.
the secondary market for these private loans could freeze entirely.
And that is the exact systemic feedback loop we saw with the collateralized debt obligations, the CDOs during the GFC. The underlying assets couldn't be priced, they couldn't be traded, and that just froze credit across the entire system.
The illiquidity acts as a massive accelerant of the crisis. If investors try to pull their capital or liquidate assets, the lack of buyers means fire sales become inevitable, driving prices down even further and amplifying the losses for everyone.
Okay, so opacity, illiquidity.
Yep.
What's the third risk?
The third risk is interconnectedness. It addresses who is actually bearing this exposure.
And it's not just hedge funds speculating.
No, this is institutionalized risk. Pension funds, university endowments, sovereign wealth funds all over the world, they hold an estimated 20% of this $1.7 trillion AUM.
Which means a crisis here hurts retirees. It hurts universities.
It hurts the core of the institutional system. And if this market hits that projected $2.8 trillion size, the Boston Fed, as far back as May 2025, flagged major stability threats. They warned that if just a few large funds freeze withdrawals or suffer major losses, the contagion risk across that institutional core is very, very high.
We have to look at the structured side of this market.
Right.
During the GFC, CDOs, specifically the ABS CDOs, became toxic because they were bundling low-quality subprime mortgage tranches.
Right.
How do the current collateralized loan obligations, the CLOs, relate to that disaster? Are we just repeating history?
They're structurally related, but they're not identical. It's a key distinction. The GFC calamity was driven by ABS CDOs, which took the lowest-rated, riskiest pieces of residential mortgage-backed securities and then repackaged them again.
The original sin was the terrible underwriting of the subprime mortgages themselves.
That, combined with completely flawed correlation assumptions. That market is essentially extinct today. Current CLOs are different.
Because they're pooling leveraged corporate loans from generally large, diverse corporate borrowers, not residential subprime assets.
Exactly. CLOs pool senior, secured leveraged loans. They use the same waterfall mechanism, creating AAA, A, B, and equity tranches, but the underlying collateral is generally of a higher quality than the 2007 subprime pool.
But the same systemic risk driver is still there, isn't it? The assumption about how these assets correlate in a stress scenario.
That is the ghost in the machine. And what's fascinating here is the current pricing distortion in the CLO market itself, which seems to be driven by a kind of post-GFC trauma.
The market is pricing in fear.
It is, which creates this huge, compelling arbitrage opportunity. And at the same time, it signals deep systemic anxiety. Analysts have pointed out that the aggregate market value of the CLO liabilities, the tranches being sold to investors, is trading about $37 million cheaper than the underlying corporate loans they hold.
Wait, that's a staggering gap. The market is saying the sum of the parts is worth significantly less than the whole. Why would that discount exist?
It reflects a deep-seated skepticism about the ability of these structures to withstand correlated defaults. And, critically, a fear over illiquidity if market confidence falters. Look at the Chelsea Park CLO example,
Okay.
an AA-rated tranche, the second most senior piece of the structure, which should be insulated from all but the deepest losses. It recently traded at 45% of par.
An AA tranche trading at less than half its face value. That implies an immense perceived risk of loss.
But the yield must be astronomical.
It offered a 23% yield, and that yield is the price the market is putting on the fear of a sudden, widespread loss event. While the underlying assets might be trading at, say, 67.9% of par, the aggregated CLO liabilities are only trading at 56.3% of par.
That $37 million difference isn't a math error. It's the price the market is attaching to correlation risk and illiquidity risk. That's it. And if we look back at the GFC, the models failed because the rating agencies assumed the correlations between subprime mortgages were low, maybe 0.22. But when the housing market cracked, correlations spiked to 0.8, even 0.9.
Meaning everything defaulted together.
Everything defaulted together, wiping out tranches that were supposedly ironclad protected.
So the same risk applies now. If, say, 10% of the underlying corporate loans in this private debt CLO warehouse default in a clustered way,
Due to a recession or maybe a sudden deflation of an AI bubble.
the domino effect could be catastrophic.
Exactly. Fitch predicts that default rates could easily multiply by 5 times in a real stress scenario. If that clustering happens, the losses cascade so quickly through that waterfall structure, you could potentially trigger mass CDS auctions across thousands of names at the same time.
Which brings us back, full circle, to our sentinel, the CDS. In this dark, opaque private debt market, how is a public, liquid instrument like a CDS used to gain any insight at all?
And this is where we see the really sophisticated application of financial engineering. Investors are using single-name CDS as a synthetic liquidity bridge. It's an overlay for their private debt positions. But more importantly, we rely on the CDSI-EDF.
The CDS implied expected default frequency?
Yes, because it far outperforms the standard expected default frequency that's derived from equity prices, especially in these illiquid private markets.
And why does the CDS implied model perform better when the underlying asset is hidden away?
Because the CDS market is a clean, liquid environment that is solely focused on credit risk expectation. Equity prices, on the other hand, are influenced by 1,000 things: management changes, market sentiment, buybacks, general volatility. The CDS spread just cuts through all that noise.
And we've seen this play out in a crisis before.
We saw it vividly during the initial phase of the COVID crisis. The equity EDF model often lagged, but the CDSI EDF for these illiquid credits showed a 124% median rise in implied default probability. It was signaling embedded losses and underlying credit stress long before those losses were officially acknowledged in the quarterly private debt reports.
So it's the superior tool for seeing into these dark markets.
By far.
Okay, so we've identified 2 enormous fault lines here: the debt fragility of the AI pivot, using Oracle as our case study, and the systemic opacity of the shadow banking system in private debt. If you're an investor or even a regulator watching all of this, how do you mitigate these risks using the refined financial engineering tools we've discussed?
Mitigation really involves 2 steps. First, you need superior detection, and second, you need smart hedging to contain the tail risk.
Let's look at detection first. How can that CDSI EDF be leveraged to provide that early warning?
We use the CDSI EDF wedge as our primary alert system. Remember the Oracle case. The CDS implied a 1.1% default probability versus the equity implied 0.5%.
That 1.8x premium.
That premium is the quantified liquidity risk. So leveraging models that synthesize CDS data allows firms to identify specific credits, even ones with high-flying equity valuations, that are carrying an undue systemic or liquidity premium. If that wedge is wide, the market is telling you the credit is fundamentally riskier than the stock price suggests.
And once you've detected that risk, how do you quantify the potential damage in your private portfolios? This is the hard part.
For portfolio quantification, especially in private debt where correlation is the killer, we have to turn to highly specialized simulation techniques. Specifically, Monte Carlo simulations combined with advanced copula models.
Copula models.
Right. And the standard Gaussian copula assumes events happen randomly, which we know is wrong in a crisis. So we use the T-copula model because it correctly captures fat tails.
The tendency of extreme events, like defaults, to cluster together far more often than standard models would predict.
Exactly. So these models help you prepare for a systemic freeze, not just one isolated bankruptcy. By running these stress tests, you can calculate your portfolio's value at risk, or VAR.
Give me an example.
Take a hypothetical $100 million private debt portfolio. An unhedged simulation might show a 95% VAR of, say, a 25% drawdown in a severe correlated stress event.
A 5% chance of losing $25 million or more?
Right. But how much can a CDS overlay reduce that extreme loss? The difference is dramatic.
How dramatic?
If you strategically apply even a 5% CDS overlay, so you're buying protection on the most vulnerable names or sectors in that portfolio, the simulation shows that the drawdown VAR can be nearly halved. It shrinks from 25% down to 12%.
So the CDS provides that essential synthetic liquidity and loss capping right where the cash market just freezes up.
That's its function in a crisis.
And finally, for structured products like CLOs, which are inherently complex, what's the most surgical way to cap that tail risk?
For participants who are willing to take on structured product risk, the most surgical approach is tranche hedging. The vast majority of losses during a clustered default event get absorbed by the most junior parts of the structure.
The equity and the junior mezzanine tranches.
Right, which typically absorb the first 10% to 15% of all losses. So investors who are looking to cap those deep tail losses should specifically buy protection, synthetic insurance, on those most junior tranches.
And that prevents them from being completely wiped out by the exact correlation spike that brought the system down in 2008.
It mitigates that specific risk. By hedging the junior tranches, you're essentially buying catastrophic protection against a market-wide failure of your correlation assumptions.
This entire discussion has really been about the evolution of leverage fragility, hasn't it? We saw it nearly destroy the system in 2008, which led to the necessary Big Bang reforms.
It did.
We see it today in the specific debt-fueled AI bets like Oracle, and we see it looming even larger in that private debt shadow market.
The lesson is clear. Leverage, when it's coupled with opacity, always creates systemic fragility. And the exponential growth model for private debt, currently at $1.7 trillion, suggests that this risk exposure is effectively doubling every 3 years if it's left unchecked. It's following a logistic growth function that's common to unregulated markets.
And the standardized CDS and these advanced models, they're powerful sentinels, but that's thanks to the lessons of the GFC. And those lessons were applied to a public liquid market.
Which brings us to the real question for the future.
Yeah.
And it's a regulatory and structural one. What role must future ISDA protocols, those quiet administrative infrastructure updates we talked about, what role must they play in standardizing and mitigating risks specific to these private illiquid assets?
It's not enough to fix the public markets.
No. We need valuation standards, we need required reporting, we need standardized settlement mechanisms that can reach into this $1.7 trillion shadow market. If Big Bang protections are to truly secure the system for the long term, they have to extend to these new frontiers of shadow banking before that opacity and illiquidity trigger the next major systemic tremor.
That's the necessary evolution.
It is.
So Oracle's aggressive CDS surge is the current microcosm of risks in debt-fueled AI, while the private debt market's opacity risks a much slower but potentially much deeper crisis. And the CDSI EDF model remains our most robust sentinel in this volatile landscape.
Investors absolutely must prioritize these advanced analytical tools and strategic index hedging to truly navigate the risk. Vigilance isn't just a virtue in this environment. It's the absolute necessity for survival.
Thank you for taking this deep dive with us. Continue to explore this volatile landscape, and we'll continue to give you the signal you need to see through all the noise.
Farewell, and stay well informed.